Hey everybody, David Skarica here. So sorry, no stock chart of the day yesterday. A few days ago, I don't know, I got some kind of stomach virus and um I kind of been running, let me put it this way. My toilet seat's been my best friend for a few days, so I apologize for that. So I just wasn't in the mood yesterday as the day was playing out, the market was down so big, I kind of just wanted to watch play out. We'll do two stocks today to make up for that. Okay, so that's what we're gonna do. So we're gonna look at Tesla and Ford, both which had terrible earnings. So now we have to ask ourselves: yes, the GDP came out stronger than expected. We all know expected. Sorry, but we all know that GDP is a rear view mirror thing. Like in 2008, for example, I think actually there was 3% growth in the second or third quarter before everything fell apart, and we were in the worst recession basically since the Great Depression. So you have to take these things, with a grain of salt, as they say. So, yeah. So this is Tesla. They reported weaker sales, weaker deliveries. They said that this year's growth is going to be lower than expected. We already know that Tesla is majorly overvalued when it comes to what automobile stock should be trading at anyhow. And it does look like, again, this kind of 270 to 300 area, which has been resistance on Tesla going way back to 2022, again, acted as resistance. Now, how does it top? You can see in 2022 or 2023, there were numerous, starts and fails and declines and rallies before it really fell apart the first half of this year. So do we see rallies and up and down? But it does look like Tesla is probably topped in all probability here. And then Ford today also had very, very weak earnings. You can see Ford, dumping off a cliff, breaking through its short-term support, breaking through its 200-day moving average. And I would say really the next move for Ford is kind of like that $9 to $10 area, which was in 2022 and 2023 kind of acted as support. So Ford's really just in this trading range from about 14, 15 where it hit recently. It just shows you how, sometimes the market, it just shows you the reflexivity. What George Soros says is that the market is always wrong. I don't believe in an efficient market theory. The market discounts. Ford discounted nothing, right? And for terrible earnings, Ford was breaking almost at new highs here. They had terrible earnings, Tesla with weak earnings. We've seen now a break in the Nasdaq. And again, remember a few weeks ago, I talked about how, I'll talk about this in a second, 200% of GDP, Buffett indicator, market cap to GDP, that is nosebleed levels. It's very difficult, even in a good economy, for the market to rally. So now, do we just see a correction like last year, which, by the way, also started in July, and just a slow move down into the summer? Or do we see something more serious? I think we're going to see something more serious because of the extreme nature of the valuations and because of the parabolic nature of all these charts. And of course, we've talked about NVIDIA and that sort of thing as well. So now we've seen a near 10% correction from the top in the NASDAQ 100. You can see we're getting oversold here. The RSI is 33. This is not the time to short. One thing I've learned over the years is patient. So I would wait for a rally here. And really that first rally is really always the time to get into the shorts anyhow, because it's tough. Just like they say, don't catch a falling knife. It's tough to short like the first move like that. Like, for example, look at this correction here. If you shorted in 2022, you could have shorted this little thing here, right? Or even this thing here, because stocks have been falling all through 2022. In 2023, same thing. When the market declined, you could have shorted this here in like late August and then rode this down, et cetera, et cetera. And actually, I think we did in late October last year. We covered our shorts because the seasonals of these types of things. So we are oversold here, but just the way, and notice that this break too is much sharper than these other breaks. These other breaks have these kind of longer term kind of tops here, or were more like subtle kind of declines. This one looks a lot different. It's much quicker. And it's because, again, the market's much more overextended. It's much more overvalued. It's much more dependent on the big tech stocks. And there are ones, Google sold off in earnings. Tesla sold off in earnings. NVIDIA has sold off. That sort of thing as well. So, and also too, when you look at things like Tesla slowing sales, like Ford slowing sales, those are probably real signs that the economy is slowing. Forget what the GDP number said today. So So it's very, very interesting. It looks to me like, that when I was throwing around that 29.87 idea, I said over and over again, that's a very low probability event. Crashes are low probability. There's a reason why only 2-day crashes in the 100 plus years of history we have in the stock market in the United States have occurred. Most of these crashes take weeks or months to unfold when they start to unfold, like 2008, like 1907, like 1937, et cetera, et cetera. Even in 2000, when we had the mini crash during COVID, that was a few weeks of hardcore selling. So that's usually how it unfolds. So, and sometimes there's a topping process, et cetera. Actually, for my paying members, we will have a video out this week on past market tops, just to kind of start looking here, et cetera. So I do think, though, that we are seeing the top. I do think that the earnings from large auto manufacturers like Tesla, like Ford, is a warning sign. Let's just quickly look at GM here. Yeah, you can see GM is kind of down in coordination with Ford. Same kind of thing, huge rally in GM. And this just shows you why when you buy is as important as what you buy. If you had bought Ford in late 2023, you could have almost doubled your money, or sorry, GM in late 2023. And if you had bought it, I don't know, in the last few months, you now be down 10 to 15%. So I think that's really important to know. And that's why I don't chase. That's why I prefer to wait for assets until they get cheap. So I really want you to take a look at these things, et cetera, et cetera. That sort of thing, anyhow. So I do think Tesla earnings, Ford earnings are kind of a warning. Let's quickly look at the S&P as well. And you can see the S&P has kind of come off too. We're now, we're not off huge on the S&P. We're off more like 6% or so, but you can see here. So maybe when we get overvalued, we get that bounce, but it definitely looks increasingly like we're seeing this kind of topping formation. I've talked about the Dow theory. I've talked about market cap to GDP. I've talked about price to sales, especially price to sales and market cap to GDP. We're talking like you're in the 99th percentile in terms of overvaluation. And that usually does not work out very well, right? So these are the kind of things I've talked about, et cetera, et cetera. So I think I'm going to leave it at that for today. So it's 2 for 1, Ford and Tesla. I do think this is some sort of sign that we are in the topping period for the markets. I know the Fed is going to begin to cut, but maybe it would mean that. Tomorrow we're going to look at the TLT. And what I kind of find interesting, though, is even with some of these bad earnings, poor earnings, even with the signs that the Fed is going to cut, TLT is not really rallying. And I've talked about in the past all this debt that's coming onto the market, plus the debt they're issuing. And I really think it's this supply of debt. That's what the market's looking at. Now, I just said that markets aren't always forward-looking, but maybe that supply of debt has started, because it's going to happen over the next year. So whatever the case may be, there is something going on that has the market worrying that the bonds aren't rallying as much as they should. And I think it's just the debt load, supply of debt, et cetera. So anyway, that's for tomorrow. But today I just wanted to show you Tesla tanks on earnings, Ford tanks on earnings. We're seeing the signs that the market's starting to roll over, and it happened right when the market hit 200% of GDP. So everybody take care, and I hope you enjoyed today's stock chart of the day.